Imagine you spent 10 years doing everything right. You skipped the vacations, you drove the old car. Except that $50,000 you saved buys less today than it would have 10 years ago. Your bank gave you a 0.01% interest, but inflation took 3%. You lost ground every year, even though you were being the responsible one. That's not a personal failure. That's what happens when nobody teaches you that saving money and building wealth are two completely different things. This video is going to fix that. Here's the identity shift that changes everything. Right now, most of us move through the world as consumers. We earn money, we spend money, and we save whatever's left. That's the game most people are playing. But there's another game, one that most people never even realize exists. It's called being an owner. When you buy an iPhone, you're a consumer. But when you buy Apple stock, you're an owner. When you own a piece of Apple, you get a tiny cut every time they sell something. Stocks are not lottery tickets. Stocks are ownership stakes in real businesses. Companies with employees, products, revenues, and customers. When you invest, you're not gambling on a number going up. You're becoming a part owner of a global economy, which over long periods of time has only ever done one thing: grow. Since 1926, the US stock market has returned about 10% per year on average, and we expect this to continue. Why? Because the economy keeps expanding. More people, better technology, higher productivity, and new industries. But here's what nobody warns you about: the price of admission. To earn those long-term returns, you have to survive the short-term terror. The market drops 20% or more roughly every 4 years. These crashes feel catastrophic when you're in them. The headlines will say the world is ending. But here's the reframe that separates wealthy investors from everyone else. Volatility is not a malfunction. It is the price of entry. The people who panic and sell during crashes, they not only lock in their losses but also miss the explosive recovery. They end up buying high and selling low, the exact opposite of what you need to do. In the short term, the market is unpredictable, but in the long term, the market tends to go up. I had to learn that emotionally in 2020. When COVID hit, almost everything I owned was red. And even though I knew crashes were normal in theory, it feels very different when it's your actual money disappearing on your screen. I had a lot invested, so yes, I hesitated, but I still bought during the crash. Unfortunately, I didn't go all in. A good amount of cash stayed on the sidelines because part of me was still waiting for it to fall more. What pushed me to buy was simple. The prices were low, and I learned crashes are where wealth gets built. And I also had enough money outside the market that even if I was wrong, it wouldn't dramatically change my life. 6 months later, the market came back harder than the Fast and Furious sequel. My biggest regret wasn't buying, it was not buying more. That crash taught me the difference between understanding market crashes conceptually and understanding them emotionally. The lesson? By the time it feels safe to invest again, the sale is already over. If you genuinely believe the world will be more productive in 10 years than it is today, and history says it will be, then a market crash is not a catastrophe. It is a gift wrapped in fear. Okay, so stocks are great, but which stocks do you buy? Apple? Nvidia? A biotech company you heard about on Reddit? Here's the honest truth. Nobody knows what will do well a decade from now. Even professional fund managers with decades of experience fail to consistently beat the market. If they can't reliably pick winners, the odds that you or I can do it from our phones are not so great. So what do you do instead? You buy all of them. No, I don't mean you go to Schwab and buy a share of every company in existence. I learned this the hard way. Back in 2019, I thought I was building wealth the smart way. I only had about $1,000 to invest, so I started buying what I called cheap stocks under $100. Nike, Delta, American Airlines, stuff that felt affordable. And honestly, I felt like I was on the highway to becoming a millionaire until I saw Google. $1,000 a share and completely out of reach. Not to mention, I was also exhausting myself trying to figure out which company deserved my next $100. Then, I watched one of Graham Stefan's videos and heard him explain ETFs. My exact reaction was, holy shit, this thing exists? I immediately changed my strategy that day. So, what's an ETF? An ETF Exchange traded fund is a single investment that owns hundreds or thousands of stocks all at once. When you buy a broad market ETF, you own a tiny piece of Apple, Microsoft, and thousands of others simultaneously. Think of it like this: instead of betting on one horse, you're betting on all of them. Real quick, if you're getting value out of this video so far, please subscribe to the channel. Now, let's talk about bonds. Most people either ignore them or misunderstand them. Bonds are simply loans. You lend money to a government or company, they pay you interest, and eventually give you your money back. Your return depends on how risky the loan is and how long it lasts. So, how much of your money should you put into bonds? That depends. If you're nearing retirement, you will need a large amount in bonds. Most investors should keep a small portion in bonds, just enough to cover whatever life might throw at them over the next 2 to 7 years. That money should not be fully exposed to the stock market, which could drop 40% the week before you need it. I didn't fully appreciate this until I lost my job in late 2025. Luckily, by that point, I had built up about $60,000 in bonds, and that cushion changed everything. Instead of staring at my stock portfolio wondering what I needed to sell, I felt calm. I knew I had at least the next year or two covered without touching a single stock. That's the real power of bonds. And for some investors, that cushion becomes ammunition. When markets crash, they sell bonds to buy stocks at a discount. They're not there to make you rich. They're there so life never forces you to sell your investments at the worst possible moment. REITs give you real estate exposure through the stock market. You'll get some dividends, but not much price growth. Most alternatives, gold, hedge fund, private equity, can generate better returns and more diversification, but they can also be expensive, illiquid, tax inefficient, and overkill for beginners. So, what does a real starting portfolio look like? Keep it simple. A broad global stock ETF as your core, something that owns thousands of companies across the world. If you're young and your timeline is long, this does the heavy lifting. Pair it with a small bond allocation to cover what you might need in the next few years, or simply to help you sleep at night when markets get ugly. And if you want real estate exposure without buying a property, a small REIT slice gets you there. Now, here's why this combination works. Different asset classes don't move in sync. In 2008, when the S&P 500 collapsed by 38%, high-quality bonds actually rose by over 5%. The goal is combining assets that react differently so one disaster doesn't wreck everything. But the right mix looks different for everyone. Your portfolio needs to be built specifically for you, your timeline, your goals, your stomach for volatility. Once you've built it, automate it. And when the market crashes, because it will crash, do nothing. Doing nothing in a panic is the hardest, most valuable thing an investor can do. Nobody teaches you this stuff in school. You graduate knowing the quadratic formula, not the power of investing and ownership. Wealth is built by people who can stay in the game long enough for time to do its job. But everything I just told you is completely useless if your financial foundation has a crack in it. One job loss, one emergency, and suddenly you're forced to sell at the worst possible moment. Most people skip this step and find out the hard way. So before you put a single dollar into the market, watch this next video. We're covering exactly how to build your foundation the right way, because the best investment strategy in the world means nothing without a proper foundation.